Hi, everybody. Professor Henry here. I wanted to do a video to give a little bit more detail on a topic that I didn't get to talk much about in class this week. The topic is rights offerings. Rights offerings are another mechanism by which companies can uh, raise capital by issuing equity shares of stock. Um, it's a little bit different from this general cash offer of just offering shares to the general public at some market price. We're talking here about offerings um, of companies that are already publicly traded. That is to say, these are seasoned equity offerings only. It doesn't work for an IPO or as an alternative to an IPO. It's an example of what's called a privileged subscription offering, in that only existing shareholders are given the chance to buy the new shares. They're given that privilege to subscribe to new shares that are being offered. Basically, the idea is this: the existing shareholders of the company are given a certain number of rights. And what a right is kind of like a call option, if you're familiar with those. It's basically the right to buy newly created shares at a price considerably below the current stock price. Now, why would you do this? Well, it is possible to do a general cash offer, but the pricing is tricky, just as it is with an IPO. I have an example here. XYZ company, suppose, well, let's see, their initial condition is they have 1 million shares outstanding and they are priced at $50 per share. So the company already has a total equity value of $50 million. We're told that they want to raise $20 million of equity capital for whatever, building a factory, whatever it is. So one thing they could do is a general cash offer and just say, okay, whoever wants to buy, we're going to offer 400,000 new shares at $50. That's $20 million worth. Uh, and that's a possibility, and this does happen from time to time, but it has some complications to it. One being that it's kind of hard to sell new shares for the same price as the old shares. If we offer 400,000 new shares at the current stock price of 50, well, there might be buyers for them, but because the price in the market is 50, we kind of know that there are no uh, buyers willing to pay more than 50. If there were, the price would probably be higher. Uh, it's kind of hard to set the price at the current market level and still expect to sell all the shares. And what if the market price declines? What if the price falls from 50 to even 49 or 48 between the time we register the offering and when it actually closes? Nobody will want to buy shares for $50 that they can just call their brokerage and place an order to buy for 48. So it's a little tricky to set that pricing right. And if you do set the price at a discount, a significant discount, say you set the price of the new shares to be $40, well, that kind of disadvantages the current shareholders, because your current shareholders have $50 per share tied up in the company. Now you're proposing to offer uh, strangers, new investors, a chance to buy that same share for $40. Um, Tends to not be very popular with stockholders, to say the least. So one alternative is this rights offering. And again, the idea is that existing shareholders would be given the chance to buy new shares at a pretty steep discount relative to the current price. So in this situation, we have 1 million shares outstanding. The company wants to raise $20 million. So they can set the price of the new shares, the subscription price for the new shares, at $20, offer new shares to the existing shareholders at $20 each, well below the current market price of 50. If they are all sold, the company will raise its $20 million, and there's no reason to think they wouldn't all be sold, because the stock price is currently 50. We're offering the chance to buy new shares for 20. That's a bargain. The existing shareholders should be happy to grab those new shares. So how would this work? Remember, our original condition was that the company has 1 million shares outstanding priced in the market at 50. So the company's equity value, shareholders' equity, is $50 million in total. According to this offering, we're going to offer another 1 million shares at a price of $20 each. So we're going to raise $20 million. That's going to result in a cash inflow to the company of $20 million added to the asset side of the balance sheet. There's no change to the debt, so that equates to $20 million worth of additional equity as well. After the offering, we're going to have 2 million shares of stock outstanding, the original 1 million plus the new 1 million. We're going to have shareholders' equity amounting to 70 million in total, the original 50 plus the new 20 million in cash. Notice something here. After the offering takes place, you should expect to see the stock price adjust and, in fact, go down. Now our company's equity is worth $70 million. We have 2 million shares outstanding. So the price after the offering should drop from 50 down to 35. And again, that's not what we usually hope for with financial decisions that we make to see the stock price fall like that. But it's not surprising here. And it's not necessarily a problem because the price represents a significantly larger company, a fraction of a significantly larger company. And there are more shares outstanding. So it represents $35. Each share represents $35 of equity value, just as we would expect. If you encounter the term in the chapter or in the assignments of the X rights price, what it refers to is the price of the stock after the offering takes place, after the effect of the rights. That's what this $35 is called, the X rights price. From the perspective of an investor, suppose you owned 100 shares of this company. How does this affect you? Your initial condition here is you own 100 shares. They're worth $50 each. That means you have $5,000 of your money tied up in this company. After the offering, assuming you exercise the rights, which you probably should do, assuming you exercise the rights, you'll buy 100 new shares, so you'll have 200 shares in your account afterwards. You will have invested another $2,000 to exercise those rights, so you're investing another $2,000 into this company. Yes, the price of your stock fell from 50 before the offering to 35 afterwards, but you shouldn't be too upset about that, because if you think about it in terms of how much you've invested and how much it's worth after the offering, you're not really harmed by this. After the offering, you would have invested your original $5,000 plus an additional $2,000. That is $7,000 invested in the company. Now you own 200 shares, so 7,000 divided by 200 is cost to you, let's say, average cost of owning these shares at $35. So effectively, you've paid an average price of $35, and they should be trading at an X rights price of $35. So no harm done. You haven't really lost any value. You just have a bigger stake in a larger company. Nothing more than that. Yes, it does create a problem if you choose not to exercise your rights. In the yellow box at the bottom here, you can see what could happen from this. If you choose not to exercise your rights, then, yes, if you don't do anything, your 100 shares of stock will decline in value from $50 before to $35 after, and you will have lost $1,500 worth of your investment. But one of the things I said about rights a few slides back was that these rights can be exercised, meaning you use them to buy the new shares, or you can sell them. If you sell them, they become what's called warrants. They're basically call options, a little bit different from call options, but it's the right to buy a share of stock at a price below its market value. Basically, they are deep in the money call options, and they can be sold. So how does that work? Well, if you don't want to invest another $2,000 in this company, or you can't afford to, you do have the ability to take those rights that you receive from being a shareholder, sell them to somebody else. Each of those rights gives the holder the opportunity to buy a new share of stock, a new share of this XYZ company stock for $20. Now, we've just figured out that after the transaction, the stock price in the market should be somewhere around $35. The right gives the holder the chance to buy that $35 share for $20. The difference is 15. That's what we would call the intrinsic value. If this were a call option, that's exactly the term we would give to it. The intrinsic value of this option is $15. If you owned it, you could exercise it for an immediate gain of $15. So you should be able to sell those rights for at least 100 shares, 15 per share. You should be able to sell those rights for at least $1,500 in total, maybe more, but let's just stick to the intrinsic value. So you have, after this transaction, if you choose not to exercise the rights, but rather sell them, you would have your 100 shares of stock. We would expect them to be worth $35 per share, and you would have sold 100 rights for, let's say, $1,500. Taken together, you have $3,500 worth of stock now and $1,500 in cash. Again, you're not worse off, but just by choosing not to participate in the rights offering, you're agreeing to, well, end up with a smaller fraction of the company and some cash, basically selling off part of your stake in the company for a fair price for cash. One of the questions you might encounter related to this material, the rights offering material, is something like, here's the story about a rights offering. What's the value of one right? And basically, that is the intrinsic value that we talked about. If you're asked to find the value of a right, it's that $15. The presumed X rights value of each share minus the exercise price of the right. How much it's worth, how much you expect it to be worth per share, minus how much it will cost the rights holder to buy that new share. It's the intrinsic value, and we would say that is the value of a right. You're likely to see questions like this, describing a transaction in these terms and saying, what is the X rights price? Or alternatively, what is the value of a right in this situation? Things can get a little bit more complicated because, as I mentioned earlier, we have a pretty simple setup here with each old share receiving one right. That's not necessarily the case. Sometimes it's the case that stockholders receive one right for every 5 shares that they own. And it's not always necessarily the case that it takes one right plus $20 to buy a new share of stock. Sometimes it takes 2 rights or 3 rights or 4 rights or something like that to buy a new share of stock. So there can be some complications there, but the examples in the book, the examples in the Learn Smart exercise take you through some of that. Hopefully this gives a little bit more insight into how these rights offerings work, why they're done, and the consequences for investors who find themselves on the receiving end of such a thing. Hope that helps. See you next week.